Well, are you about to retire in the worst possible time? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Well, I'm often asked, how in the world do I come up with content for a daily radio program? And basically what I do is I get content from conversations that I have with clients, with people who talk to me about their financial situations, both good and bad. I also skim pop culture finance. I look at the Wall Street Journal every day, all kinds of resources to pick out what I think is very relevant to your situation. And I came across a very interesting article that I kind of put aside, and knowing that I'll probably get to it, but just hadn't done so yet because I kind of have things in line as to when I'm going to talk about it. This was called This article is called Baby Boomer Jeopardy in Target Date Funds. Low risk, 20% chance of loss. High risk, 40% chance of loss. And it talks about a lot of things kind of rolled up into one article that I've been talking about for a while now. And I read through this article and wanted to just basically read some of it to you, talk a little bit about what it means, and help you ask the right questions as to how you want to handle the possibilities of what looks like and could be a very tough market if you are in the situation today where you might be retiring in the next 5 years, or you've just retired and we're looking 5 years ahead. So basically, there's like a 10-year period of time there. And what it talks about is the use of target date funds, which I thought it was interesting because I've always said that target date funds kind of gives the investor the illusion of safety. In theory, what it does, and I want to stress in theory, and I'll tell you why in a bit. In theory, what a target date fund is an investment that you put your money into based on the year that you're going to retire. 401k plans are just populated with this type of with these types of investments. And what people who set up 401k plans and companies and are in charge of making sure that everything is in the best interest of the employee, they love these because it's a very easy concept. You find the date you're going to retire, you plug your money into that particular fund, and what it's supposed to do is year after year, as you get closer to retirement, it is supposed to reduce risk and get you at a point to where you've got the perfect balance of safe and maybe riskier investments. Now, the theory of the target date fund, what they call is risk and what they call less risk versus more risk, I would disagree with. And of course, not saying they're right or wrong, just don't agree with them as to what constitutes risk. And so I think, and I've seen this in investment returns in the past because I've managed money through the tech bubble in the early 2000s and then the financial crisis in 2008. And these target date funds or these types of funds didn't do so great when they should have been taking hardly any risk at all. But as you would imagine, when it comes to pop culture finance, they're going to err on the side of taking more risk than less risk. That's just kind of the way it goes. But they talk about in this article they talk about sequence of return risk, peaks in the risk zone spanning the 5 years before and after retirement. Most baby boomers are currently in the risk zone. So that risk zone, let me break this down what it means. The risk zone simply means the 5 years before plus the 5 years after retirement. If you fall into that risk zone, you do risk running into a sequence of return risk. And what that means is that, in the last 18 years has been a great time to be in the market. You've never had a long-term cycle where you've jeopardized your retirement. What this is saying is that they're looking for, in the study that they've done, this 5 to 10 year period, that if you're in this period near or in retirement, that the likelihood of you experiencing a very large decline are greater than if you weren't in this type of retirement zone. So basically what they're saying, what I've said for a long time now, is that it all comes down to cycles. The market moves in cycles. It goes from good cycles to bad cycles is the easiest way to put it. And those cycles are alive and well. The bigger the good cycles, the bigger the bad cycles. And we are in the largest good cycle that has ever been in history. And, at some point, these good times, they end, and things cycle back to bad and tough, uncertain times in the market. And of course, I'm sure you could put the list together as well as I can. There is a number of things that could easily change the cycle or the trajectory of the stock market. Now, when we're talking about that, and we're talking about what the stock market could end up doing over the next 5 to 10 years, it could have a simple correction. I mean, I would almost feel that's a certainty that's going to happen. But it's important though to get the definition of what a correction is. A correction is nothing more than a maximum of a 20% loss in the stock market. And if you have a 20% loss in the stock market, you probably have close to that in your investments. Especially if you're the more invested in equities or stocks that you're in. And the whole idea of a correction is that it corrects the excess and the market bounces back and keeps going. I think there's a great chance that happens, but that's not necessarily a game changer. The game changer is when we fall into a bear market cycle that lasts for anywhere to 1.5 to 2.5 years. That's what is the game breaker, and that's what can ruin or significantly damage a good retirement. And that's when I read through this, I thought, I want to talk about this today and really start a conversation. And just know, if you got questions about this, if you got questions about your own situation, you can go to prudentmoney.com, go to the Ask Bob section, send me an email. We'll start that conversation. So the retirement risk zone, once again, 5 years before, 5 years after. This is a little bit pop culture related, so that's why I was surprised to see this article. And it sugarcoats this a little bit. I don't think, though, that there is I think that we always look at what are the probabilities of something happening, not to be a gloom and doomer. This is something that if you prepare, well, let me back up and say this too, not trying to predict or forecast. I just think it makes sense to be ready and be and to know what you're going to do if this sort of thing happens. And so the bear market cycle would last for a long time. What a bear market cycle does is it steals time from you because you have to spend all this time making up what you've lost. And I would say that if the stock market is losing over 30%, so let's say that is a line in the sand. It could easily go to 50 to 55%, maybe even as much as 60%. And there's some investment gurus who say that that's a real good chance of happening. But back to this article, though, there's a 40% chance that the typical target date fund will have at least one losing year during the next 5 years. And depending on how bad that year and what's leading up to that year and what follows that year will determine how significant that is. I mean, if you look at how bad the financial crisis was between 2007 and 2009. The financial crisis, and this is really important. The financial crisis started in 2007, ended in 2009, and the stock market made money in 2007, lost money in 2008, lost about 38% that year, and made money in 2009. But the average investor suffered somewhere between a 40 and 55% loss. And the stock market was like right at 55%. So not that would be a pretty tough one. And they talk about that, the allocation of target date funds, that the typical allocation is 55% in stocks, 35% in bonds, and 10% safe. The typical safe, and I would almost agree with this. I think there's still a little too much in stocks for right now, and that's not a recommendation. It's just an observation. They have 30% in stocks, 10% in bonds, and 60% in safe investments. So the probability of a correction, I think, is real good. The probability of a bear market cycle is, I think, unfortunately, pretty good as well. So it's a situation that you just have to be aware of. It says in the past 18 years, this has been the longest bull market ever. Stocks and bonds have gone up every year except 2022. Stein's law says if something cannot go on forever, it will stop. 40 million baby boomers will be in the retirement risk zone for the remainder of this decade, during which losses can ruin the rest of life. There's a 40% chance that the typical TDF, or target date fund, will lose money in at least 1 year remaining in this decade. That's a bad gamble. See, I don't think that they're saying lose one money in 1 year. Well, most people lost over 20% in 2022, and they came back, and it was really no big deal. So it kind of gives two messages. I think that you got to be extremely, extremely careful about how you're invested, and make sure that you are comfortable with the risk that you're going to take. And here's the problem: is that the stock market has been so good over the past 18 years. People don't really remember the 2008 financial crisis. They especially don't remember the 2000 tech bubble and the preceding problems that we had with that. So, the message is, don't think that it can't happen. And I was talking to a gentleman who was a mutual fund manager, and he was telling me, all the great things that there are to like about the situation. Well, just keep in mind that, and I would disagree with that, just because I think that all you have to do is read the studies, read the resources that are out there in financial media. People are struggling; they're having a tough time. The statistics say so. And also, unemployment is a lot worse. And the problem is that you have a whole political body in Washington that's trying to make everybody think everything's okay. Don't worry about it. If you believe it to be true, it has to be true. Well, it doesn't. I don't know that it works that easily. And so it really comes down to understanding what risk you're taking. And it's tough. Let me get back to what I was saying. When it's tough is that the last 18 years have been so good, and people have made so much money that they look at it and they go, I don't want to miss out. Or I want to get to at least this level before I get out. And I have had a really interesting conversation with a friend of mine about this. And I think this really sums up where a lot of people are today. He had an enormous amount of money in his 401k plan, more than he'll ever spend in a lifetime. And he said, it scares me to death to see what the stock market's doing. But yet, if you look at what his investments are, the way they're invested, he's got at least 60 to 70% exposure of his portfolio to stocks, which is a little bit problematic. I mean, I personally wouldn't be carrying that much. And he goes, retirement for me is about 5 years away. He's in the retirement zone. And I just don't want to lose any money. But he wanted to get to a certain point before he sold and changed to something very, 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 very conservative and very risk averse. And I said, you want me to help you, and I'm happy to do that. And you want me to tell you when, I'm happy to do that too. But I'm not going to play the odds and roll the dice on the casino table to see much longer I should keep this invested, and then exit for you, and tell you when to exit. It's just, if you're ready to go, if you had a good time, even though the party's still going, you think it's a good time to go out the back door, then take it. Do what you feel comfortable with. Do what you have that gives you peace, where you feel God is leading you. And this is also, I think, a time to test your relationship with your financial advisor and make sure that you're both on the same page. Financial advisors are not having that many conversations today, I would imagine, about a bad market, because people in these types of markets that have gone up over this 18 years worth of bull market. When I say bull market, I mean things are good. The stock market's going up more than it's going down, way more than it's going down. And people are thinking in the back of their mind, yeah, this is going to end, but boy, I don't want to miss out, because AI is going to take us there. So let's talk a little bit about AI. And if you look at, let me take a global look at the market. If you look at the economy, you look at the market, for a certain population of what they call those the haves are doing great. They're making more money than they know what to do with, and they're financially set. Then you got the middle class. Then you got the have-nots. That's what they call that. And the middle class is alarming, in an alarming way, decreasing. And you've got a situation where the haves are getting richer and the have-nots are not. They're not progressing, and the middle class is getting squeezed. And this, when I was talking to my friend who is a fund manager, we were talking about this. He said, yeah, but you need to consider where we're going in the future. And I said, the one thing that you can't debate is that this stock market is very, very overvalued. And you've probably heard of that phrase before, a market being overvalued. And it's a situation where people are paying way more than stocks are actually worth. And there's ways to come up with that. And if you look at just about every big bear market in the history of the markets, you're going to see a somewhat overvalued, at the very least, or a very overvalued stock market. Ladies and gentlemen, we are in the most overvalued stock market ever in history. And that has only led to one thing. Now, I could be absolutely wrong, and I'm once again not trying to forecast or predict anything. I'm just trying to set the table for conversation, a conversation that you probably should sit down with your advisor and have, and just talk about the situation where, I don't want to lose a lot of money, or I don't want to lose any money at all. And a good advisor is going to listen to that and go, okay, let me tell you what we're going to do, versus trying to communicate that, well, you're a long-term investor, you should stay invested. There's a lot of people who think that the market goes up and down, but it always goes back up again. And just everything that advisors are taught to say. And I've got, and advisors look at this all very differently. I look at it one way. Colleagues of mine look at it a different way. I'm not saying they're right or wrong. I'm just saying this is how I look at it. And I've absolutely been wrong before. And I'm not trying to, like I said, I'm not trying to predict anything. And I'm not trying to say, oh, I said that would happen. Not trying to do any of that. I'm just here out of concern to tell you this is the way cycles work. This is what's happening, and you've got to be on top of what you're doing. And you've also got to realize that in order to make any changes, you're probably going to face your own emotional resistance when it comes right down to making that change and going a different route. Because you're always thinking in the back of your mind, what if I'm wrong? What if I'm wrong? What if I'm wrong? What if I miss out? What if I miss out? And that's where prayer is so very important. That's where having a good financial advisor is very important. And because you just got to pray about it. And, there's a reason that God is stirring your heart, is he wants you to be thinking about, from a stewardship standpoint, am I where I need to be? And what people will tell you is that you can't time the market, and you're not. And I want to say this: you're not trying to time a top, you're not trying to time a bottom. Everybody, the best time, because the best time to invest is at a bottom. But people think that there's a bottom along the way down, and they end up losing a lot of money. I'm not trying to do any of that. This is all about, you've been taking this amount of risk. It served you well. So now what kind of risks should you be taking going forward? In a situation where the possibilities of a bad cycle are very, very good. So that is my 2 cents. And I just, like I said, not trying to be a gloom and doomer. I just, it's really interesting. I just don't see very many articles like this that I come across that I think this is really, and not that because the writer agrees with what I think. It just is, this is what history has said possibly happens. And I always like to go on probabilities. What are the probabilities that, in fact, I could tell you 2 or 3 different scenarios that I think might happen. But let's just talk about, what are the probabilities of any of that happening? I think that they're higher than normal. And that is what is concerning, and that is what we've got to face today as investment, as an investor. So there you have it. And just keep that in mind. If you want to have any conversations about this and talk about what all this means for you, so that you can ask the right questions, so that you can be comfortable with where you are and not have to be as concerned with what's coming down the pike, have those conversations with your financial advisor. Have them with me. I'm happy to have them with you. And that you can easily do that by going to prudentmoney.com, sending an email, and we'll get you squared away. We'll have a conversation. And I always leave that open, because it is something that concerns me, as far as people having the other side of the story, the information. Because in times like this, and this is very well documented, I know there's people who think differently. I do believe we're in a stock market bubble. I do believe the stock market frenzy is out of control. I do believe that things drastically change. History would say that happens. And so I just want to get that message out to you. Make sure that you understand what you might be up against. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. If you do need to ask a question, you can always go to prudentmoney.com. There is a link at the top of the page. It says Ask Bob. Just click through that link, and we'll get you squared away. That's all at prudentmoney.com. Tomorrow, I was going to talk about this today, but like I said, I started reading this article, and I feel led to talk about this. But tomorrow, we're going to be talking about negative equity in your automobile and what you do about it, because this is really becoming a big problem. And just like the accumulation of debt defaults, we're starting to see more and more of this. And what that kind of effect has on the situation at hand. So we'll be talking about that tomorrow. This is Bob Brooks. You've been listening to the Prudent Money Radio Show. If you've got a question for me, please go to the website, www.prudentmoney.com, and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. questions, or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.